G'day guys, welcome back. In this video, we are going to talk about one of listed REIT companies, real estate investment trust, called Charter Hall Group. It has the ticker code CHC. The way I approach this is more in the investment point of view instead of the real property investment expert. I cannot tell you out of 1,300 properties that Charter Hall has with the funds over 52 billion, whether the location is worth it or how many tenants and how long those tenants gonna last. That's not what we're gonna do in this video because that's not my expertise. What I can show you is that after reading 15 annual reports since 2006, I have come up with some lessons that is really important to share for anyone who's interested in investing in real estate investment trust companies such as CHC, because we need to look at how did they perform after the great financial crisis in the period of 2007 to 2009. If you look at the price chart of Charter Hall Group, you're seeing that they have reached the share price in 2007 and then lost at least 90% of its value because of the financial crisis. Although since then the CAGR has been impressive with 10-year CAGR of 21%, 5-year CAGR of 23%, we need to ask the question, does the share price reflect earnings growth and also the net asset that Charter Hall Group has? It is very risky to invest in REIT companies just by looking at the dividend yield. Based on June 2020 results, they have a dividend yield about 2.4%, and as you can see, the past 10 years the dividend yield has been steady and increasing. But the other thing to consider as well, REIT companies compared to LICs, they do not give fully franked dividends. The other thing I want you to consider as well, that investing in real estate is not easy. If you look at 4 listed REITs that Charter Hall manages, such as CLW for long WALE, CQR for retail, CQE for the social infrastructure, not all of them are doing well, particularly the retail one, because the past 5 years it has a negative 4% CAGR. We are lucky that Charter Hall Group still have their annual reports available since 2006, because it gave us a chance to learn from real estate investment trust bubble that happens in 2007. They also impacted not only CHC but also Goodman Group. You see the orange line here, followed by Mirvac, MGR, Dexus with the blue line. So far, only Charter Hall Group that has grown its share price beyond the pre-GFC period. Without further ado, let's get into it. Thank you to Gurpinder for suggesting to look at this REIT company. After looking at those 15 annual reports, all the market cap is highlighted with the blue line, and I'm using the share price of June of that particular year, and I'm using the market cap instead of share price because we take into account how many shares that they issue, because that's the nature of REIT companies. You gotta borrow more, you gotta use more capital to acquire more property, and therefore will give you more management income. We've got the yellow line here as the net asset, that is the total asset minus the total liability, and so far from 2006 to 2020 it has been steadily increasing. Next we have the net profit after tax and PAT with the red line on the bottom. There is a period where they reported a loss around 2009-2010, but over 10 years since 2011 the earning per share growth has been 21%, and that is a good sign. If you see earning per share matches with the share price, that means this valuation is still pretty reasonable. Let's talk about the bubble that happens and it pop. When you see Charter Hall market cap that reached over $4 billion in 2007, it leaves a big gap to its net profit, and therefore the price to earnings, which is essentially market cap divided by net profit, to be ridiculously high. That is over 100, and it happens just before GFC. The other thing to highlight as well, from 2006 to 2008, Charter Hall has done really aggressive borrowing. If you look at the debt to equity ratio that they have, from 2006 to 2008, it reaches as high as 60%. They need to borrow more to acquire more property so that they can generate more management income. So when the GFC happens, people lose confidence, people are more hesitant to lend and borrow from each other. Nobody wants to invest in real estate investment trusts. You start seeing the PE gone down to even matching its net asset, matching its book value. If you see this arrow here around 2011, even in 2009, the valuation has gone down by quite a lot. And when you see the gap between the market cap and the net profit is narrowing, that means the PE has gone smaller. You'll get a lot of value investor excited. But fast forward 10 years from 2011, the PE ratio we got based on July 2021 is about 21. This is based on June 2020 earnings. Now with the GFC, Charter Hall need to restructure all of this capital and finances. But more than that, Charter Hall needs more confidence from investor. One group that is interested in helping Charter Hall is Gandel Group, and it is reported in Charter Hall Group Annual Report 2009. Basically, Gandel Group invested 75 million to Charter Hall Group, giving them 12.2% stake. Just imagine 12% stake in Charter Hall right now in 2021. With a market cap of $7.2 billion, that stake is worth about $878 million. From 75 to 870 million, that's about 11x, 1100%, or about 23% CAGR. However, John Gandel, the billionaire behind Gandel Group, sold his stake in 2016 for $500 million. That's a difference about 370 million. From John Gandel perspective, he's got nothing to lose. All he needs is to just give support and endorsement to Charter Hall Group and getting high return from it. This channel, I always recommend people to invest in your circle of competence. And to be honest with you, property is not my circle of competence. There are some things that I think is important in property investment, such as location. You gotta trust the managers to manage the capital well. The other thing that I noticed after looking at the 15 annual reports is that employee expenses compared to net asset is really high in real estate investment industry. If we compare it with LIC, I'm already criticizing a lot of fund managers who charges 1% of the net asset to the shareholders. But in the property investment, it is way higher. Say in 2006, they started really low. They gotta attract investor. The employee expense to the net asset is really low, it's less than 5%. But then recently, since 2012, it has gone up to close to 10 to 8%. And if we look at employee expense to the management income that we receive, it is ranging to 40 to 95% of the income. So my take is that this property management are expensive, and it's no surprise that they have to create an illusion that they're rich with their Range Rover or fancy cars and fancy dress. But really, it's a cost charge to the shareholder. Also, this video is only on my investment point of view. I don't have enough expertise to tell you those 1,300 properties will do well, whether their location is, but at least I'm honest. If you look at other investment websites, for example, Motley Fool with the Foolish Takeaway, they talk about in the investment point of view as well, but then they give recommendation that I think Charter Hall share price remain a very good investment based on dividend yield. But I think that kind of valuation is not enough. Because if you think of it, Motley Fool makes money from people subscribing to their services. In conclusion, I like how Charter Hall Group learned from their mistake in 2007. They are a lot more careful with their debt management. Now their net asset and their earnings can justify the market cap of over $7 billion that they have. And I want you to learn from the example of John Gandel, who made 75 million investment and turned it into 500 million. Because if you want to be a billionaire, you gotta learn from them. Again, invest in your circle of competence. Property investment is a very capital intensive and it's a very high cost operation with a lot of risk. Things can go wrong, buildings can collapse. There are many dodgy builders out there. There are many dodgy real estate agents out there, and some sectors are not COVID pandemic proof. Of course, property investment is lacking the liquidity if you compare it to, say, investing in shares. Thank you so much guys for watching, and I'll see you in the next video.